We're really pleased to have everybody joining us this Monday afternoon. Hope that your week is starting well, and welcome to Episcopal Parish Network's digital workshop on financial planning and what you need to keep in mind as you are beginning to look at your financial plans for the future. My name is Joe Swimmer. I'm the Executive Director of Episcopal Parish Network. It's terrific to partner with Grace Longo, who is a personal financial planner, works with clergy and laity across the church. And we encourage you to not only take this information that's being shared today for yourself, but suggest to others that they might want to watch this recording as well. The recording will be sent to everyone who is registered for the session. It'll also appear on our website in our library of digital workshops. We have many more digital workshops coming up in the next month and a half or so, and I invite you to look at our website, which is listed in the chat, and see what is of interest to you, and hope that you'll join us again soon. But without any further ado from me, I'm really pleased to turn it over to Grace and to her colleague Larry to chat a little bit about best practices in financial planning. Thank you both for joining us today. Thank you, everybody who's attending, and we'll look forward to seeing you on another digital workshop very soon. Thanks so much, Grace.
Hi, everyone. Thank you, Joe. That was great. I am so happy to be here and to be presenting with Larry. As Joe had said, I have been with the church since 2008, working through the church pension group. As an employee, and now I work as an independent producer. I do retirement planning, life insurance planning, long-term care planning. I noticed, though, that most financial professionals, including myself, really do not talk about debt. I work with a larger group called Guardian Financial, and their sole purpose is to bring retirement planning and group benefits to other denominations. And there I can partner with them to do other areas of practice that I don't do necessarily myself, like asset management. And this is where I met Larry, and he showed us about Your Family Bank. And I thought, this is a great program. Larry is so passionate, committed, dedicated to helping people that it really made me want to become an authorized representative. So I want to turn it over to Larry. He is, like I said, he has, just as I have 30 years of experience, he's been in the business since 1987. He is the founder of Your Family Bank. And I look forward to talking to many of you. If any of you have done planning for wellness, that's something that I used to do, and we talked about debt. And one of the things about debt is that you would see physically people in the room kind of slump their shoulders and kind of you could feel the burden of this debt, and how it's hindering their ability to accomplish their financial goals. So I think you will find Larry's presentation really inspiring. And after the presentation, this is all complimentary. You could have a conversation with me, and we can talk about how this information pertains to your situation. Okay, Larry, go ahead.
All right, Grace, thank you so much. Joe, thanks a lot. My name again, Larry McLean, founder of Your Family Bank and Church Legacy Ministries. As Grace said, we've been in the business since 1987, and we're basically a financial planning firm. That's what we've done. We have a platform with Charles Schwab and all the things in the whole world really of financial planning. But one of the areas that most financial planners do not address, and that is debt. And one of the biggest problems today in America is because of the debt situation. The government is $34 trillion in debt. On a personal debt side, we're only $17 trillion, but we're only half as bad as the government. But at the end of the day, 80% of American people are today in debt. I did some statistics, and talking about pastors in different areas of the clergy, if you will, we found that 90% of pastors work over 46 hours a week. 81 said that they have insufficient time with their wives and family. 80% felt that the family were adversely affected by the ministry. 75% reported significant stress-related illnesses, and 70% had personal financial problems and stress. And as Grace said, that we do work with pastors, directly with pastors and staff members, but from that is the people that are in the church. And one of the biggest problems I feel in the church world today is people's debt. And a lot of people don't understand really how debt really affects their retirement program. And so in most cases, not every case, but most cases, if we can show people how they turn their liabilities into assets, they will have over $1 million in retirement. Not every time, but most times that will happen. So that's in the top 2% really of America in regards to that. So if you got the clicker, do I have it?
No, you have to use it.
I don't have it?
No, we don't have it.
Oh, gotcha. All right, buddy. Sorry. So first of all, what's the problem? Well, the problem falls into finances and debt. And unfortunately, really finances kind of runs our whole world, if you will. It's kind of the center of our universe, center of our life. If you look at that for a second. I can't get it to change. All right, thanks. So finances fall in the middle of our life. And so what is it, when we look at that, when finances are not right or out of balance, it causes problems with our family. In regard to think about, it causes bitterness. It can cause divorce. One of the leading causes of divorce today is financial stress, if we look at that. Number two, it can cause problems, child abuse, spousal abuse, even suicide. So when we look at finances affecting the family, it certainly can do that. Number two, it certainly affects our fun. We can't go on a family vacation. We can't go out to eat. We can't do the things that we normally do in fun. Maybe I have 9 grandkids. Most of them all play sports. It's very expensive for kids today to play sports, even at schools today. So sometimes it can cause bitterness in regards to that. And then it can cause problems with our friends. We can't do the golfing trip or the fishing trip or the hunting trip, or we can't do the ladies out for the weekend, or whatever the case may be. We can't. Maybe I'm the guy that invites everybody over to my house to have steaks, and all of a sudden, finances are around, we can't do that anymore. So then it can cause problems with our faith. And we look at that and we think about faith, and sometimes we get upset with God and maybe the situation that we're in, or we stop giving to church, or we stop going to church in regards to that. So it can cause problems with our faith. Matter of fact, sometimes we can get angry at God. And then with our fitness, it can cause problems, that we don't go to the gym, or we're not eating the healthy foods that we once were when finances were a better situation. And we look at that and we start gaining weight, and all of a sudden we get depressed in regards to that. And so it causes problems with stress-related illnesses, certainly. 65% of all people that go to their primary physician doesn't go for illness at all. It's all stress-related. And so then we come down to the end, which is the goal, right, is getting retired. And we talk about our financial future and having enough money to retire. And the two biggest challenges that we get in retirement is, number one, not outliving our money, having enough money to do that. And number two is taxes. And number three is our health care and the cost of that. So when we look at holistic approach, we want to look at every one of those. Not only do we want to look at it today, we want to look at what our income and provide. We call it turning paychecks into playchecks, if you will. But it's all caused by debt. And that's where the rubber really meets the road. And most people never approach debt in that way. And so about 13 years ago, I started doing this, number one, for our clients. It's helped me get out of $2.4 million in personal debt, took 2 companies debt-free. But one of the major things for my clients is showing my clients how to be debt-free, and usually 7 to 9 years or less, including their mortgage, without spending any additional money than they're spending right now. So we asked 2 questions. The questions that we ask people, number one, are you 100% sure you're going to have a great retirement? Do you have some doubt? Most people tell me that they have doubt. So what if we could show you how to get out of debt 10 years or less on the average, including your mortgage, without spending any additional money than you're spending right now? Would you do that if you could? And most people will say, absolutely, I would love to do that. Well, if we look at that for a second and we move forward, where does our money go? You know, that's the thing. It's not that we have a savings problem in the United States today. We really have a spending problem. The average American is only saving 3.8%. And if we look at that, taxes are taking an average of 24% of our income in taxes. The other side of the fence is the interest that we're paying. Another 14% of income is going to our interest that we'll never get back. We'll never make a dime on it, and that money is transferring out of our account. And debt, really, if you look at it, most Americans are spending 50% of their income on debt and the interest that they're paying. So if we go down this road a little bit, we look at, you know, charitable giving to the church. 8 out of 10 people who give to the church has zero credit card debt. They're free to give. Only 5% tithe. 80% of Americans only give 2% of their income. Christians are giving 2.5% of their income during Great Depression. It was 3.3% during that time. Only 3 to 5% of Americans who give to their local church do so through regular tithing. 37% of church attendees don't even give money to the church at all. 17% of American families have reduced the amount they have given to their local church. 7% of churchgoers have dropped regular giving by 20% or more. So if we're looking at the church world in the situation of giving more back to the church, getting out of debt is going to free to have more cash flow in order to do that. It shows 8 out of 10 people who give to the church have zero credit card debt, and that's a big, big deal when we show people. And at the end of the day, we can get people out of their consumer debt within about 24 months, and that means everything but their mortgage or their student loan debt in regards to that. So the American household today, total assets of 65, after having an average income, lifetime income of $2 million, they end up with $95,000 at retirement. Now, that's the average American today. You may be better than that. You may be not as good as that. But we won't be able to show projection on what people will have in their retirement. But when we can take, again, liabilities and turn them into an asset, it changes that picture dramatically. So do you really understand how interest works? Well, we look at financing a car, we look at credit card debt, we look at mortgage debt. These are all debts that most people are facing today and are paying. And we understand that people need a car, they need to do the stuff that they want to do, they have to have a mortgage, they have to have somewhere to live. We understand that. But at the end of the day, let's don't help the mortgage companies, all these people finance this. We call it total interest percentage, and that's just the tip of the iceberg, if you will, because it's what we don't see on the bottom that can sink the ship, if you will. And the thing that we look at, if you look at in 2021, the 30-year fixed interest rate was 2.96%. If you look at a medium home at like $399,000, the interest on that will be $204,000. Your total cost of that loan, even at 2.96, is $604,000. If you look at 2023 rates at 7.7, now they're hopefully coming down now with the interest cut, but that same house today at $399,000, the total interest went from $204,000 to $627,000. That situation brought us up to over $1 million for that exact same house today. So you're looking at over $400,000 of interest today. Well, here's what I will tell you. It really doesn't matter if you're paying 2.96 or 7.3 or 7.77. At the end of the day, we're paying a lot more than that, and I'll prove that right now. You look at a 30-year fixed mortgage, a $300,000 payment. The principal and interest payment is $1,475. And let's kind of split the difference between that. We'll look at 4.25% interest. But let's look at the real rate of return that we are actually paying, the money that's leaving our checkbook at month 1, 10 years, 20 years, and 29 years. So if we look at year 1, and this is not a misprint by any stretch of the imagination, but I have trained over 5,000 financial professionals over the last 14 years. that Your Family Bank has been in existence, and I can tell you, just about zero of them understand how interest works. Because, ladies and gentlemen, that $1,475 payment that you're making your mortgage payment is starting at 4.25%. In the first year, you're paying 72% interest. You say, Larry, how the heck do you come up with that? Well, your principal and interest is $1,475, and if you look at your interest as $1,063, if you divide that by the payment, you'll understand that 72% of your payment is going to interest. You say, well, Larry, gosh, I understand that. That's the first year, or that's the first couple of months. We get that. Okay, let's go 10 years down the road. We're 10 years down the road now, and we're not paying 4.25. We're actually paying 58% because $1,475 payment, principal and interest, $837 is going to interest. That money, number one, you'll never get back, and you'll never make a dime on that. Let's go to 20 years. We're 20 years down the road, we're still paying 34% interest on that mortgage. You said, well, wait a minute, Larry, how do they get away with that? Well, guess what? When they sit down with you and you sign that mortgage payment, that's all there. It's all in the cases that you can take a look at. But when you actually break it out and look what it really cost you out of your pocket, it's really serious dollars. So we get all the way to the 28th year. Our interest still hadn't got to 4.25%. It's still 4.5% at this point in 28. But wait, what if this? What if we could get people out of their mortgage debt in 10 years or less? What would that do? Well, if we'll back up to 10 years, that means this. Every dollar that you see on starting right there in 10 years, not only do you get the principal payment, you would also get the interest, and the interest that's just costing you. Well, ladies and gentlemen, I can tell you that by paying off that house early in a lot of cases is create a tremendous benefit for you going forward in regards to that. But that's the mortgage interest, which is usually, in most cases, the biggest payment we'll take. So what's the potential? Let's look at Mark and Joyce, a typical husband and wife. They've got 2 kids. Mark's 40, she's 39. They want to retire at 65. They have nothing for college planned yet. Their monthly income is about $4,600 each, or the spouse income is $39,000, so about $75,000 a year. Their desired retirement would be $60,000 or $5,000 a month. Their main areas of interest was college planning, increasing their savings, reducing and eliminating their debt, getting their spending under control, and increased retirement income. Now, this is a typical person out there today that we talk to all the time. I'm gonna have my assistant Caleb jump over, and I'm gonna bring up our software for a second and walk you through the Mark and Joyce and show you exactly what we're able to do for Mark and Joyce and what we've done for thousands and thousands and thousands of people each and every year. Our organization alone, we have over 350,000 advisors. We touch 2 million people a year. And at the end of the day, we touch just about everybody in some time with retirement planning, Medicare, health care, whatever the case may be, life insurance, and our annuities. But Mark here, if we look at the problem, first of all, you've got 2 problems. Number one, you've got the saver. This is a person that saves up money and doesn't charge anything, but when they get enough money, they buy something, but they never get past the line of zero. They save up again, they buy something else, save up again, and buy something else. They think they don't pay interest, but the reality of, we call that lost opportunity cost, because every time they spent that money, wherever it came from, it stopped making money for them. The second is the spender. These are the people that, like me and you, we charge things, and we have a mortgage, and we have credit cards, and we have cars, and we do all of those things today. We charge it, and we pay on it, and guess what? We charge again, and we charge again, and that's just the way life is. To have the stuff, we just keep in that situation. So how do we change that? How do we get off that road? How do we make that happen? Well, what we want to be able to do is show Mark and Joyce what we're able to do for them. So we look at they said if you added up their interest and what they owe, they would tell you they owed $383,000. But because of the interest, their real debt wasn't $383,000. It was $634,000. That's their real debt. And their total interest they're going to pay is, and I can't see it, Kayla, because you got it wrong, is $251,130. They're going to be in debt for 26.8 years. That's where they're at today when they sit down with us. Well, what we're able to do for them is this. Number one, we said, okay, this is your payments that you're making now. This is your principal that you owe to all your debtors. This is your actual payment. That's the interest rate that they're paying. And we found out they were paying, for every dollar that they were paying on their debts, 39.57% of that, almost 40%, was going to interest. That's that total interest payment percentage that we're talking about. That money, number one, is gone forever. They'll never get it back. And any dollar that we can recapture and put back in their pocket from that is dollars they can put toward retirement or for anything else. So that's where they were. And so doing what we did, we said, okay, you got to understand how banks work. Well, the theory of your family bank, right? And so creating that bank, and not like, the bank down the street, if you will, but you deposit money into the bank, and what happens? But the bank is going to pay you a stated interest rate. That could be from 1 to 3 to 4%, whatever that number is. Excuse me. Again, the bank now, if the bank, because the Federal Reserve gives that bank the right to loan that same dollar out 7 times. We're only looking at it 4 here, but 7 times they can loan that same dollar out. The bank strategy is to get you in debt. Our strategy is to get you out of debt. But I want you to see the profit that the bank's making. They're loaning that money out 15%, 12%, 24%, 29%. That's the profit that the bank's making. So the question is, you got to remember how banks operate, but number two, how would you like to be the bank? How would you like to be able to take that profit and put it back in your pocket? Well, your money's always in motion. We give every dollar 2 jobs, right? And so what do we do, and how do we design the program? Well, we redirected inefficient dollars. We sit down with our clients and find dollars that we can utilize. We use a specially designed 7702 special overfunded insurance policy, a permanent insurance policy that we've got. Number one, pays dividends and has a guaranteed rate. That's number one. Now, the first job, in most cases, is the death benefit, God forbid, or the living benefit. If someone dies along the way or someone gets sick or whatever the case may be, there's a critical care rider that they can use for that. And certainly we don't want that to happen, but that's job number one. But the reason we do it and the reason why we do it is this. We're able to take money out of that policy tax-free, and we're able to take that money and pay off student loan, credit card, and mortgage. And then once we pay that off, snowballing debt is not nothing new. Dave Ramsey certainly has done that for years, and Dave Ramsey has helped a lot of people. But the difference between our program and Dave Ramsey's program is 3. Number one, according to Dave, 90% of the people won't stay on the program or won't do what he says. 80% of the people stay on our program. That's number one. Number two, we're building wealth as we're paying off debt. Dave's program is paying off debt. We're not building wealth yet. We're building that wealth as we go. So once we pay off that debt, we take that money and that cash flow goes back, and we save interest on that. It's accumulating, and it's earning dividends at the same time. So that's job number 2 to do that. So as we pay off debt, we're building, and I'll show you this in just a second, how this thing works and builds up money for you. So how does it stack up against anything else out there? Well, you could use 401k, a mutual fund, or bank savings to help you pay off debt. I agree. But the problems with that is that sometimes it's not penalty-free, it's not guaranteed growth, it's not risk-free, it's not tax-favored, and it can't be used for leverage, and most of it doesn't have a death benefit at all. Your family bank checks all those boxes for that. We're taking that money, we're never interrupting compounding interest as we go through. So what we were able to do with Mark and Joyce, they were going to be in debt for 26.8 years. We got them out of debt in 9.5 years. We saved them $116,000 in interest that went back in their pocket. And that's a lot, right? But what we're able to do is free up $3,700 a month cash flow. That's $45,000. Based upon that, Mark and Joyce at year 30 would have $1.6 million in an account tax-free that they could utilize. With it combined with a death benefit, almost $2 million. Well, how does that stack up, though, with creating that wealth as we go? Well, guess what? We paid off debt. We freed up that $3,700 a month. Now, you'll say, well, Larry, wait a minute. When I get out of debt, will I still want to buy other stuff? And the answer is absolutely. You're not going to get out of debt and quit buying anything. We just want to give you a better way of doing it, give you a resource of your family bank, if you will, instead of going back to the credit card to use your account to pay that. I'll show you that in just a second. So where do we end up? We went from 26 years to 9.5. We paid $134 instead of $251. We have liquidity at the same period. I said 30 years a second ago, but at the same period of time that they were going to be out of debt, Mark and Joyce, we have $1.2 million. And plus with the death benefit, you're looking at $1.5 million. Again, it doesn't happen every time, but I can tell you in most cases, people end up with over $1 million for retirement today. Caleb? So how do we do it? We reduce the debt payments to minimum. We pay off our first debt. Once we pay it off, we roll that payment. We're snowballing debt. We're just using a policy to roll that money back into. As momentum builds, we pay off interest, and we build really the biggest one, which is a tsunami that crushes the biggest debt, which is normally, the mortgage or student loan debt. So I want you to really pay close attention here. This is building wealth as we're paying off debt. On the left is really them paying their bills, Dave Ramsey way of snowballing debt. So that's on the left side. On the right side is your family bank using the debt wave. And so I want to show you the difference in regards to that, how that works. So let's go 12 months down the road if we can get there, 12 months, if we can stop on 12 months, Caleb. Or maybe not, you can just leave it at, all right, there you go, 12 months. So in 12 months, Dave Ramsey way, we have now paid off our Visa and our dentist bill on the left-hand side. On our right side, though, we paid off medical, the appliances, the dentist, Visa, and the furniture. But here's what I want you to see. Look at the bottom right-hand side. We now have $5,979 in an account that's earning interest for us. Over the left side, we don't have anything. We're just snowballing that debt. So let's go to 24 months, if you can take us there, Caleb. So we're at 24 months down the road, and we've done good on the left side. I mean, we paid off 5 debts, if you will. We still owe medical, our auto, and mortgage. But look on our side. We paid off everything except the mortgage. And we've got $13,284 earning interest for it in a tax-free account. Well, if we go to when we paid off the mortgage, and if we go out there, I think it's about 114 months, Caleb, is where we're at. So now on our side, we paid off everything, including the mortgage. They've got $77,681 in an account. But look on the left side. They have nothing saved over there. They still owe $261,000. My question to you on this call right now, if this was your bill, which one would you rather do? Would you rather keep snowballing debt and you can see at the end of the day how much money we're earning on the right side and how much money we're paying on the left side? Huge difference in regards to that. So along the way, we're building retirement, building wealth, and paying off debt. But, by the way, it's flexible. If we need to pay, if we need to pull back, all those things that you can do in regards to that. So We are using some life insurance. 80% or 50% of America doesn't even have life insurance. Life insurance that covers the situation. In this case, if they need cash, they can take the money out. If they become ill, they can access that. And of course, it started at $185,000 going forward. Now, what are the benefits through your life? Number one, establish an emergency fund, use control of your money, access cash without penalty, tax-favored growth and distribution, a flexible premium, self-finance future purchases. We're talking about how we're going to buy stuff in the future. Improve our cash flow, earn interest while we're paying off debt, no loss of principal guaranteed, safe from market fluctuation, and because we're basing everything you just saw was based upon guarantees, not if the market does this, the market does that. Everything that we looked at is based upon guarantees, self-complete and tax-free. So what is our strategy as we go through? You can look at every 51, at your 51, 61, 71, 81 as you go through what your benefits will be in regards to that. So,
Larry?
Yes, ma'am.
Larry, I just want to, could you explain what the product is that is funding this? Because we're getting some questions in the chat. Okay.
Okay, absolutely. We're using a specially designed insurance product, a whole life policy. It's a mutual company. All the companies that we use are over 100 years old. All companies that we use pay dividends and pay dividends for over 100 years, although dividends are not guaranteed. They're all mutual companies. They're all owned by the policyholders, not by stockholders. So in regards to that, every year dividends are declared by the expenses of the company, claims that are paid by the company, and those interest and dividends are paid out. Right now we're paying, our dividends have been way over 5%, between 5 and 6% going forward, and what it has been. And so we're using the policy specially designed, and why we use this type of policy and why we design this type of policy. It's very early cash value in the policy. Some policies doesn't have cash value for 1, 2, 3 years down the road that you could actually utilize, if you will. Ours is totally different. Sometimes we are paying off debt in the first 90 days. So we are using a product. We're using the product instead of snowballing debt into each debt. We're snowballing that into the policy first, using that interest, because when we take money out to pay off debt, that money is still earning interest. It never stops earning interest for us, if that would help some. And of course, you know, this would break down to individuals based upon, you know, running your reports to see what that would be, and all those numbers would change, because it's custom. It's not cookie cutter whatsoever in regards to that. Any other questions? All right. So the plan, if we look at the plan today, what are your potential risks? Number one, taxes, market, inflation, outliving your money, lawsuits, fraud, disability, and debt. That's some of the risks that we're taking, so don't lose a lifetime of work. Taxes, the less you pay, the more you're going to keep in regards to that. So we want to be able to make our tax efficient, when we take in withdrawals, make them tax efficient. If you look at, you know, there's 3 types of situations. There's tax deferred, and tax free. If you take a $10,000 investment over a 25-year period and you look at a 25% tax rate with a 7% return, you're going to look at a tax account, you're going to have $34,000. With a tax deferred, you're going to have $40,000. And if you have a tax-free account, it's $54,000. Big difference if you can create tax-free income going forward. And that's some of the things that we look at. I ask clients all the time, what do you think future tax rates are going to be? You think they're going to be higher, lower, or stay the same in the future? And I can tell you this, in 2025, the tax laws right now will sunset, and taxes will definitely go higher in regards to the future for sure. So looking ahead, we think taxes will be higher in the future. Is postponing taxes really a good idea? Maybe now is the time to start doing tax planning going forward in regards to that. So the big picture is know where you're going and how to get there, and how do we do that? So there are the plan benefits that you look at. We're going to reduce the volume of interest that you're paying your lenders. You're going to have access to dollars, get out of debt in 10 years or less, improve your cash flow, decrease your taxes in the future, and save for college, retire for tax credit. Let me give you this quick story and I'll be done. I had a pastor in Dallas, Texas, that I worked with through another agent, and he was referred to me, him and his wife. They made great money. They made very, very good money, but they had a lot of debt. And they went to a certified financial planner, got a report, 42-page report. And what the report said to the pastor is, number one, he wanted to retire in 8 years. They said, there's no way you can retire in 8 years. Number two, you need to stop giving money to your church. And number three, you may want to consider filing bankruptcy. Well, the pastor said, that was really a report of no hope for him and his wife. So I said, well, Pastor, I think we can help you. We were able to do what we do, and at the end of the day, we were able to get him out of debt in 7 years and 4 months, debt-free. He was able to retire in 8 years and had $100,000 of income based upon that. When I got off the phone with both of them, the agent said, or the Zoom call, they were both crying. That's what we do. We show people how to, number one, change their whole life. So in Mark and Joyce's situation, we got them free from lenders in 9.6. We saved $115,000 of interest that they were going to give away. We freed up $3,700 a month in cash flow. And savings, they have $1.4 million. So I tell people, I said, after looking at Mark and Joyce, most people see this and immediately make a decision they'd like to be like Mark and Joyce. And my question to you, would that include you? At the end of the day, that's what we do. It's a life-changing experience. Our deal is this. Just take a look at it. Let us run your numbers for you. See when we can, help you get out of debt. We want to give people hope and help people escape debt in regards to that. Next step, just meet with Grace and get some information to her, and she can give you a personalized report. And no cost to you whatsoever. There's no charge for you to do it, but you can get in regards to that. So I'm going to leave that up, Joyce, and see if, or Grace, see if I can have any other questions I may can answer for you or help out any other way going forward.
So
I can tell you this. We're working with the, as a matter of fact, I'm doing a presentation for the head of the Texas Baptist Convention this week, actually. We work with churches all over the country, ARC churches, Assembly of God churches. I mean, we're working with all different denominations around there, and we're doing a lot of retirement planning for these people. All right, Grace, I'll shut up.
okay, so all right, so the comments are, one person said, I understand how the snowball method works, but I would love to hear about how the strategy is different with the debt wave method. Yes,
and so that's Joyce. Grace, I keep turning around and call you Joyce.
That's okay.
But Grace, that's what if the report does. The report's going to show them exactly how it works for them. Again, yeah, it takes a little bit on their side. They have to give us some information. We don't need any personal information. We don't need, account numbers or anything like that. But we would need the same thing what we needed for Mark and Joyce, which is, how much is your mortgage? What's your principal and interest? What the interest that you're paying? How much you owe? Same thing with credit cards or student loans or anything like that. Once you have that, we can go through that report and explain it and walk you through the software. And that can be done on Zoom or any other way that we need to do that.
I'm going to just butt in here for a second because I'm noticing that there are a couple of comments about this being kind of a sales pitch. And I really have to say that, that's not what this is. This program does work, and it doesn't always work for everybody, but this is a different type of life insurance product that you don't see out in the common market. And that's why we're bringing it to you. You do not have to take part in it. It is completely free. It is something that we do to help. This is not a pitch. And I am sorry that you feel that way.
Yeah,
And
let me interject this. I can say this, $2.4 million personally myself, because the principal of your family bank, I'm totally debt-free today, 2 companies and totally debt-free, and been for a long, long time. So the pitch is actually, yeah, it is probably a sales pitch. Number one, to get the information. Again, we don't need any personal information, but to get the information to look at what your report to show you where actually you could be out of debt and show you when that would happen. That's what the report's all about. So as far as me on the presenter side, you know what? It may be a little sales, so I apologize for that. But we're so excited about what we can do to help people get out of debt and show them a way that, remember, 90% of the people fall off the program. 80% of the people stay on our program. That's a huge benefit for clients going forward. So, I get it, and I may be a little salesy. I apologize for that, but I'm really excited about what we can do for people and what we're doing for people all over America today. So.
And I've used this with other people myself, just being, and it really changes their lives. It really does. We're not saying that to be salesy. Anyway, the last comment is about being careful about using the word guarantee, or definitely in finances. And Larry, you want to talk about that, the product guarantees?
Yeah, well, here's the thing. I don't have to be careful about saying guarantee, because everything you just saw is based upon guarantees. So when we look at that, we base everything that we do on guarantees of the policy. And of course, they're contractual by the insurance company that is issuing the guarantee, but they do have a guaranteed interest rate. And as long as the client does exactly what shows out the numbers that we present to the client, it's guaranteed to work. It's actually going to work better than what our guarantee is, be honest with you, because compliance-wise, there's some things that we have to do to round down to numbers instead of round up to numbers. And so in reality, it's actually going to do better. And that's things that we'll go over on a one-to-one basis to show you and answer any personal questions that you may have in regards to that. My question is, if you're not out of debt now, there's probably a reason. Number two, most people probably have tried and maybe fell off that wagon, so to speak. And so at the end of the day, why not take a look at where you can be and have a plan? That's the biggest thing, is you got to have a plan to make all of this happen. And by the way, you got to have a coach too. You got to have a mentor. You got to have someone that's going to come alongside you and work with you and walk you through to make this happen for you.
The last question was about scheduling a conversation. Again, remember, this is complimentary. We have a chat. We talk about your specific situation. And so, yes, I think if you have any interest in learning about this, just schedule using the QR code, or reach out to me by email, which is on the screen.
Yeah, so if you just take your phone and shoot that QR code, you can hit that. You can schedule a meeting right there on her calendar, or of course reach out at hello@financial-grace.com and schedule a meeting with Grace. So Grace, thank you so much for allowing me to be on to be, y'all still pray for us. I'm in Florida, and there's a hurricane headed for us, so we appreciate your prayers down here in Florida, if you don't mind. Guys, have a great day. I appreciate all of you, in regards to that, and I'll turn it back to you, to Joe and to you, Grace.
Thank you so much, Larry. It's been great. Thank you so much for your comments and your questions. And I look forward to talking with you and seeing you at the EPN conference in March.
Have
Thank
a
you
great
so
day.
much.